The Boxwood Alliance is a nonprofit organization. We assist and provide services to well, we don't provide the services. We provide a sort of a clearinghouse for seniors and caregivers to find information in the lower Hudson Valley about things that are available to them, from home care to activities. It really runs the gamut. So we try to put on these monthly webinars, of which we change the information each month to a different topic. We are completely volunteer run. Nobody gets paid for what they do. We do it in order to help the community, and we are always looking for volunteers and or people who might be interested in contributing to us, because the only way we keep running is to raise funds. So that's a little bit about the Boxwood. Our website is theboxwood.org, and all the information, all the things that we provide are available on our website. And again, that's how we need money to keep the website running, these kinds of things. This is kind of what we do. So I am the presenter today. My name is Colin Sandler, and I am a social worker and a certified care manager, and I help seniors and their families to go through the Medicaid process and get long-term home care services. So that is basically what I'm going to be talking about. I'm going to just get my PowerPoint up, and I am going to share my screen so you guys don't have to look at me. And what I'm going to do is, unless somebody has a problem hearing us and you need me to speak up or anything else, we're going to try to keep all the questions and answers, if there are any, to the end. You can type them in the chat box. You can type them in the Q&A. And at the end, if you raise your hand, after we're finished, I can answer your questions by unmuting you. But just so you're all clear, you are all muted during the entire presentation, and you are also, you won't have your picture shown. It doesn't mean that you're not here. It just means that we are not, it's just the way the webinars work. Only the presenters' pictures are seen. And I apologize, that is my computer talking to me. So I'm gonna try and turn the volume down there. Okay, so this is just a little note for everyone that, you can raise your hand using the icon. You can type a question into the Q&A or in the chat. All of those things work for communication. Since I'm moderating and talking at the same time, I don't know that I can keep my eye on all those things while I'm talking. So I probably will take a peek at that as we get through the process. So basically what we're talking about is long-term home care services, community Medicaid, and institutional Medicaid. It is a lot of information. I'm trying to keep it to a half an hour. So just so you know that I will be going sort of fast, and it's not something that we can, that it can take hours. So I'm going to go fast, and we'll do the best we can. So in New York State, and by the way, this only pertains to New York State. So if you have loved ones or family members that live elsewhere, then this does not apply. The rules are different, run by each state. There are certain federal guidelines, but each state has their own implementation of their Medicaid services. So community Medicaid is for home care services, long-term care at home. Medicare covers brief home care services after an acute event. Somebody falls and breaks their hip, goes to the hospital, goes to rehab, comes home. Medicare can pay for a brief time. But Medicaid is meant for long-term, more custodial type care. And community Medicaid can also cover an assisted living program, a Medicaid assisted living program. Not every assisted living offers this by any stretch, but if there is a facility that accepts Medicaid, it's community-based Medicaid that's going to pay for it. Community Medicaid, aside from the home care, can cover daycare, but daycare are closed due to the pandemic, and typically covers things like incontinence supplies and medical transportation. Most people do apply for community-based Medicaid to get long-term home care services. Community Medicaid currently has no look-back period, but that's going to be changing in April, and I'll talk more about that in a moment. Nursing home Medicaid covers a long-term placement in a nursing home. Again, back to Medicare. Medicare usually only covers a short-term stay after a hospital stay, and after 20 days, or depending on your insurance, there's usually copays, which some insurances cover and some do not. So anybody who's staying in a nursing home beyond the time that their insurance covers would either have to pay out of pocket or consider getting nursing home Medicaid coverage. So what does a look back period mean? When we say it has a 5-year look back, or that community Medicaid has no look back, what does the word look back mean? It basically is a very intense review of all your financial information over the course of whatever period of time they're looking. Nursing home is 5 years. In most counties, they are looking for transactions in or out of your bank account over $2,000. So if somebody has a check that they wrote for $2,500, they're going to have to produce a copy of that check when they file their Medicaid application. If they have 17 different bank accounts, they're going to have to provide 5 years worth of records for all 17 bank accounts, every page, every month, for 5 years. And yes, Medicaid does go through every page of every month for 5 years looking for those transactions. And anything they see, they want further verified. Not just money coming out, but money coming in. They see a $2,500 deposit that isn't a direct deposit from a pension or Social Security where it's clear cut on the account. They're going to want to know the source of that money. And you have to go back to the bank and get a copy of the deposit slips and the checks that were deposited, because they want to make sure that you don't have money coming from a source that you did not disclose. And they are ultimately looking for gifts. They're looking for money that people have given away to their family, to their children, for which they got nothing in return. So I write a check to my kid for $15,000 because I'm a very generous mom, and that's a gift. And Medicaid in a nursing home would penalize you for giving away that money. So that's what the look back period means. For nursing home. Nursing home Medicaid is not changing, but community Medicaid, which is home care, is changing. As of today, being December 3rd, you can still transfer assets and qualify for community Medicaid without any penalty. And you can do that at this point until April. As of April 1st, any Medicaid applications that are received will be subject to a look back period that is very much the same as the nursing home, but it will be shorter. Starting in April, the look back period will go back to October 1st. A lot of people have read and heard in the news that the Medicaid rules changed in October. They did and they didn't. What they did is they set October as the time, basically the line in the sand. They're never going to look back for community-based Medicaid past October. But starting in April, they're going to want to see 6 months worth of records from April back to October. And if any money was given away in that time frame, you'll be penalized. As the months go forward, that look back period will grow. So in April, they'll be looking for 6 months worth of records back to October 1st. In May, they'll be looking for 7 months worth of records going back to October 1st, and so forth until we get to April of 2023, when Medicaid will be at the full 30-month look back, which is what the community Medicaid changes are going to be. So by April of 2023, there'll be a 2.5-year or 30-month look back for community Medicaid and a 5-year look back for nursing home Medicaid. For anyone that files anytime after April 1st, if they moved their money before October 1st of 2020, they're still protected. So it doesn't matter when you apply if you did your asset planning and protection prior to October 1st of 2020. However, if you didn't do any planning and you're doing it now, if you don't apply before April 1st, you'll then be subject to a look back period. So That's a really important change to understand, because there are people who don't need anything now and are thinking about the future, or there are people that kind of need something now and are on the fence. And for those people, now is the time to really look at Medicaid benefits. So, how do you qualify for this? Is community Medicaid, but it really is the same for nursing home to a great extent. So, there is an asset requirement. The asset requirement for a single person is $15,750. That means that they can have no more than that in what Medicaid refers to as countable assets. If you have a married couple where both people are applying, mom and dad are both going to go on Medicaid, then they're allowed to have a total of 23,100 combined. And what are countable assets? It's any asset that has the name of the applicant or applicants if it's a couple, such as checking, savings, CDs, investments, stocks and bonds, annuities from which there's no income, 529 savings accounts, which are college savings accounts. That's a big one. People don't really think about it when grandma and grandpa say, we're going to open a 529 for our grandkids when they're 60 years old, the grandparents. Now, by the time the kid is 17 and getting ready to go off to college, grandpa gets sick and he's 75. That 529 account belongs to grandpa, not to the kid. So 529 accounts are not good for grandparents to hold as they get older. Properties other than your primary residence, if you are staying at home. So if you're staying at home, the property you live in technically is not counted as an asset, but if you own a house in Florida and you own a house upstate in addition to your home here, they would be considered dollar for dollar an available asset. So you have a house in Florida worth $100,000, that's as if you have $100,000 in the bank. They also look at cash value of life insurance. So what that means is not the death benefit, but what is the policy worth if you were to turn it in today? That's what cash value is. So if you think about life insurance, most people know about term and whole life. Term policies are not, have no cash value, so they're fine. But people who have whole life policies do have cash value, and literally, again, dollar for dollar, the cash value counts as an asset. If you have a life insurance policy that's worth $80,000 in cash, you will never be able to qualify for Medicaid as long as you have that policy. So depending on the circumstances, you may have to cash it in. What is not a countable asset? What does Medicaid exclude? They exclude any retirement accounts, with one caveat, that you are taking per month the amount that income consistent with what the IRS says a required minimum distribution is. So if you think about, like this year, 2020, the government said you don't have to take a required minimum distribution from your IRAs because of the pandemic. Medicaid does not follow those rules. You still need to be taking a distribution from your retirement account in order to protect the principal. So if you have a $200,000 IRA and you have to take out $1,000 a month as per the IRS, the $200,000 is protected, but the income would count as income. Westchester and Putnam use the IRS life expectancy table to determine how much you have to take out of your retirement account. However, pretty much the whole rest of New York State uses a different life expectancy table. And why that is important to know is in those counties, you actually have to take out more than the required minimum distribution, because the life expectancy table they use has a shorter lifespan, therefore requiring you to take more money out of your retirement account to render it exempt. So typically it can be 2 to 3 times more that you're required to take. So whereas the IRS might say you have to take $1,000 a month to satisfy the required minimum distribution, in Dutchess County, they might say you have to take $3,000 a month in order to protect that account. So that's an important thing to know regarding which county you live in. New York City also, and all the boroughs of the city also go with the IRS rules, but Long Island and everything, Rockland and north of Putnam does the other life expectancy table. So assets owned by your spouse Technically, if they're not, if you have a husband and wife and the husband needs care and the wife does not, the wife, if she owns the assets by herself, even if she moves assets from her husband to her, she can, the husband can qualify for Medicaid under something called spousal refusal. But there are some risks there. The state can come after, the county can come after the well spouse and insist that they pay. So you can do that. Technically, they don't count when the spouse refuses, but you leave yourself open to having the county try to come after the well spouse's money. Assets transferred to an adult disabled child are always exempt from Medicaid. It doesn't matter. So if you have a 50-year-old son who went out on Social Security disability because he hurt his back, and dad needs to go into a nursing home or needs long-term care at home, literally all of that money could be transferred to that adult disabled child without penalty, even if it's done immediately before filing. That's a nice little loophole if you're unfortunate enough to have an adult disabled child. Your primary residence is not a countable asset as long as you live in it, or somebody such as a spouse, an adult child caregiver, or a sibling with a legal interest lives in the home. So if mom is going to a nursing home but dad's staying in the house doesn't count as an asset. Unfortunately, though, Medicaid does have something called estate recovery, and they do come after assets of both either husband and or wife when they pass away. So if you are doing community-based Medicaid and getting care at home, or even if you're doing nursing home Medicaid where there's a well spouse at home, there really should be some additional planning with the property to ensure that you don't protect it now but lose it later. So that's the difference between countable assets and not countable. Pretty much most things are countable, unfortunately. So the big question people always have is, how do I transfer my assets? If you're going into a nursing home, all bets are off. You really can't transfer your assets and qualify for Medicaid in a nursing home unless you are transferring them to your spouse or your adult disabled child. However, if you're in the community and you want to transfer money, there are really two ways that you can do it. If you're going to transfer assets and apply for community Medicaid before April of 2021, you can still qualify under the old rules, meaning they don't penalize you for transfers. But if you transfer assets now and do not apply for Medicaid until after April of 2021, you will be then subject to that 30-month look back. Some people opt to use irrevocable trust to protect their assets. If you're well and healthy and older, now would be the time to do an irrevocable trust for your assets and hope that you make the 30-month look back period for community Medicaid, because if you don't need it now, you're not applying now. If you are married, the rules about the October 1 transfers don't apply to couples. So if we have a married couple and they did no planning and the husband gets sick in May of 2021 and he subsequently transfers all his assets to his wife, he can apply for community Medicaid under spousal refusal. You do run that risk under spousal refusal of them coming after you, but they can transfer money between spouses or the adult disabled child. So that's really assets. It's not that simple. There's a lot to think about. There's a lot to consider. Then we have income. So income is handled differently than assets. So if you're single, if you either are widowed or you never married or you're divorced and you're living at home, you can keep up to $895 of your monthly income, which is basically the poverty level in the state of New York. Technically, it's $875, but if you're over 65 or disabled, you get an extra $20. Your monthly income is only increased by the cost of out-of-pocket insurance premiums. So if you pay for AARP or something like that, they will allow that on top of the $895. However, if your health insurance premiums are pulled from your pension, then you're going to only be allowed the $895. And this is before taxes. So if you have taxes withheld, Medicaid's going to add the total income you're getting before taxes into your budget. They do not discount for taxes being withheld. Any income over that 895 or the 895 plus your health insurance premiums is called a spend down or excess income. And with that spend down, you can either pay it to Medicaid towards your care, or you can use something called a pooled income trust in the community only, so not for a nursing home, to protect the excess income. And most people do that who are staying at home. By the way, if you're going into a nursing home and you are single, they will take 100% of your gross monthly income and you get a $50 a month stipend. So there is no protecting income if you are going into a nursing home. It all has to go to the facility towards the cost of your care. So you cannot use a pooled trust for nursing home care. If there is a spouse, you really have two possible scenarios. One is that, hold on a second, let me just make sure that we don't have a question. If you let me go here, I apologize. Okay, just want to make sure. If you don't need to say anything, I'm going to keep going. If you are married, you have two budgets that you can consider: spousal impoverishment, which means that you are married and you have a gross monthly income below $3,214 a month. In that scenario, the spouse that's staying out of the nursing home can keep 100% of the money. You can also use this if you're at home and using something called managed long-term care, which is for home care. Or the spouse can do spousal refusal. So in some situations, the income is much higher than $3,200 a month. So the well spouse can refuse to contribute their income to the sick spouse. And in this instance, sometimes we still use a pooled trust for the spouse. Again, this stuff is complicated. I'm giving you broad strokes just to give you a feel for it. And it makes a lot more sense to people when they are actually talking about their own situation rather than in general terms. So when you go to a nursing home, again, you can't use a pooled trust. 100% of your income goes to the nursing home unless you are married, and then either the well spouse keeps their income and the ill spouse's income goes to the nursing home, or if the income is low enough, the well spouse gets to keep everything. If not, and you're home, you do a pooled trust. This is just a little sample of what a pooled trust would look like. So this make pretend person here gets a total monthly income of $1,294.60 in Social Security, $550 in pension, and $500 in monthly IRA income. Again, before taxes, before exemptions. So that's $23.44 a month in monthly income. But they are paying $144.60 out of their Social Security check for Medicare, so they take that off the top. And then this person pays for a supplemental health insurance plan and a prescription plan. And then they're allowed to keep the $895. So if you look at these four items in red, they're the exemptions. They're the things they get to keep. But they're still over the income limit by about $922. So that is where we do something called a pooled trust. We put the $922 a month into the pooled trust, and the pooled trust does have a monthly fee as well as an annual fee. The trust fees vary from trust to trust. Some do a sliding scale, some do a flat 10%, but on average, it's somewhere between 7 to 10% of your monthly deposit. The money that goes into the trust can be used to pay your personal living expenses, only the expenses of the person on Medicaid in the trust. So if dad is living with his children and doesn't have any bills in his name, it might be difficult to use the money in the trust because he has nothing to submit to the trust. In that situation, I would encourage the child to set up a lease and charge him rent. You can use the parent's credit card as something that the trust pays, but it has to be in the name of the person who's in the trust. And then the money that's left in your checking account, which is all these red items, except for the $144 from Social Security, you can spend as you intended. So that's how a pooled trust works. You do have to be considered disabled to be in a pooled trust. So in addition to doing all the paperwork for the pooled trust, if you never collected Social Security disability, there is a package that needs to be completed and sent to the Medicaid office, which goes to Albany. Albany stamps it approved and it comes back. I have yet to see in all my time anyone denied the disability designation unless you didn't provide the paperwork. The designation, the bar is very low. They see a diagnosis of dementia, that's just a rubber stamp right there. But even heart disease, COPD, osteoporosis, pretty much anything that is there, they will consider you disabled. So, how will the new Medicaid rules for community-based Medicaid impact people going forward? So, as I indicated before, there's going to be a penalty. And again, we're not worried about that right now, but 4 months from now, it will be a problem. There is the slight possibility that the April deadline will be pushed back further. If we are still in a state of emergency with the pandemic, as we get closer to April, they will probably push out the change further. It was supposed to happen in January. In October, they said we're still in a state of emergency. We are moving it to April. There's some law that prevents them from making major changes to Medicaid rules while you are in a state of emergency. So that's yet to be seen. So what do you say what does that mean when they say you're going to penalize you if you've transferred assets? Basically, they use the Medicaid regional rate. And in the Hudson Valley, which is, I think, from Dutchess County down through Westchester County, it's about $12,850 a month. So Medicaid says for every $12,850 you gave away, we refuse to pay for your care for a month. So with a nursing home, that's pretty much close to the cost. They are a little more than that, but it's pretty close to the cost. For home care, most people are paying less than that. So there's a little more wiggle room. In the home care scenario, I use specifically this number, but if you gifted $128,050 and then you applied for Medicaid, they would divide that by the monthly regional rate and you would get a 10-month penalty. What that means is for 10 months, you'd have to pay your care out of pocket. But at the end of the 10 months, you'd be eligible for Medicaid. And if your care costs less than $12,000 a month, at the end of the 10 months, you would have sheltered some money. Let's just say you're paying $4,000 a month for home care. And we apply for Medicaid as soon as you transfer your money. They'll apply a penalty. And after 10 months, you'll have spent $40,000 on your care. But now you're Medicaid eligible and you actually protected $85,000. So that is kind of the concept that people use. People do the same thing for nursing home. If somebody walks in my office and says, my mom has $128,000 in her name and we're going for a long-term nursing home placement and we did no planning, we kind of do the same thing, but a little bit differently. What would happen, and you need a lawyer for this, is you gift half of the money to your child and the other half is made into a promissory note, which is a loan. Loans are not penalized, but the gift is. So the gift, let's just say $60,000, is going to make you ineligible for Medicaid for about 5 to 6 months. So now you're going to have to pay for 5 to 6 months. The combination of the money loaned, paid back on a monthly basis, and the person's income should cover the nursing home for the 5 to 6 month penalty. And in the end, the family gets to protect about half the assets. So that's a pretty good strategy that people use when they go into nursing homes when they haven't done any planning. This is a piece about home care. I'm going to go through this even super quicker than anything else because I've rounded up to my half an hour. But right now, to get home care, there are really two mainstream ways to get home care. And the real mainstream way is through something called managed long-term care. Managed long-term care is very much like an HMO. New York State does currently have a 2-part process for evaluating you for this program. The first part is through New York State. They do an assessment to make sure that you meet their qualifications, but they don't determine your hours. Once the state says you're a candidate, then you have to pick an insurance plan that will come out and do an assessment. The assessment is really purely task-based. They do not give hours for safety or supervision. So when you call, and I can't tell you how many times I've seen this, the child will say, my mother keeps falling, she's high risk for falls, she forgets to eat, she gets mixed up, she really needs somebody to supervise her. That doesn't buy you much in the way of hours because they don't pay for supervision and safety. They will pay for dressing, bathing, toileting, walking, transferring, housekeeping, laundry, things like that. So as a result of them not having to provide supervision and safety, the managed care companies have gotten really good at um, providing very limited services by using some of the loopholes in the rules that they've been given to say you don't qualify for additional care. The good thing is that you can get into a managed care program in anywhere from 2 to 6 weeks after your Medicaid is approved. So it's a fairly quick turnaround. And they do manage everything. They provide any incontinence supplies. They're the ones that contract for your transportation, etc. For people who have more dementia-based services or more supervision-based services, who really don't have a lot of heavy physical care, but really can't be alone because they're not safe. Nursing home transition and diversion program is a very underutilized home care program, and it is a home care program. It is meant to transition people home from nursing homes or divert them from going into a nursing home. This also has a two-part process to enroll. First, we have to send you to, they call it a regional resource development specialist. It's an entity that basically starts the paperwork to see if you meet their criteria for the program. Once you do, very similar to the other program, you then have to pick a company to coordinate your care. And that company then does their assessment, decides how much care they're going to give you, and submits your plan of care to the state. It's a waivered program, so they do take a lot more time to bring you on board. It can take 3 to 6 months sometimes, usually a minimum of 3 months to get on board. But they can provide supervision-based care. I have people getting split shift from the nursing home transition program who got offered 24 hours a week from a managed long-term care program. So it really is a great option. With either plan, you have the ability to use your own caregivers, called Consumer Directed Personal Assistance Program. You can choose anyone to be your caregiver. It can be a family member, but it cannot be a spouse. The person has to be legal to work in the US, willing to be on the books, and unfortunately, you're subject to the pay rate that the agencies pay, which are typically close to minimum wage. So on Long Island, in the city, it's $15, $16 an hour. In Westchester, there are a couple of companies that pay $15, $16 an hour, but as you go north into Putnam and north, it's $11, $12, $13 an hour before taxes. But it is a great opportunity if you really want to hire your own people and want to know who's in your parents' home. So that's the home care piece. And that's pretty much it. I know I went really fast and I apologize, but I wanted to get it all in. So I do see one question, and I'm just looking at it. So if it's okay, I'm going to read the one question and then I will get to the other person who raised their hand. So he's saying that we have a couple in their early 80s. The husband is a double amputee caring for a spouse with dementia in their home, and she just broke her hip. And she'll be coming back to the home on Monday, and he cannot handle her care going forward. They have about $50,000 in savings, and they have a monthly income of $2,800. And he says, any ideas? So this person is in Michigan. So I can't answer your question in Michigan. I can tell you that if they were living in New York, we could certainly get the wife on community-based Medicaid because the husband could keep the savings. They have $2,800 a month in income combined, so they would fall under that spousal impoverishment level. So that is, I'm just going to stop my share so I can see things. So that is how that would work as far as a couple like that. But the rules in Michigan could be completely different. Most states, actually only New York and Florida, are the only two states that allow that spousal refusal. So those are the only two states at all that a spouse can refuse to contribute. Every other state does not allow that, which means the spouse is completely financially responsible regardless. However, I'm fairly certain that spousal impoverishment Medicaid exists in other states. So that couple may fit into that, although the limits may be different. I do believe the 78,000, I think, I'm sorry, 74,000 and change is the asset limit, which I do believe is federal. And I think the $3,200 a month might also be federal. So that would be something to double check in your area. So I don't know if anybody has any other questions. If somebody is interested in having the PowerPoint sent to them, you can either email info@theboxwood.org, or you can email me directly, Colin@medicaidsolutions.com. And I'd be happy to send you the PowerPoint. We hopefully will be posting something on the Boxwood website, which will be a recording of this. So if somebody else has a question, I can certainly answer. I don't know if anybody does. Carolyn, did you have a question? Because I can unmute you if you want to ask a question. Thank you, Susan. Susan said I'm not muted.
Okay. I unmuted myself, Colin. Thank you for the presentation. You're a really good teacher.
Thanks.
And it's a lot of complicated material.
Yeah.
This could probably be a subject for another presentation, but briefly, obviously people need a lot of guidance and help with this issue. Using a geriatric care manager, using an elder law attorney, can you speak to the sort of the pros and cons of, which choice to make, or how that works?
Absolutely. I mean, okay, I'm going to be very honest. I'm biased, of course. I think people should talk to a geriatric care manager, a Medicaid specialist who's not an attorney, at least first, to get the lay of the land, to really understand what their options are. Does this work for you? Is this the right direction? And then depending on the level of assets that the person has or the strategy you're going to implement, very often you do need to then involve an elder law attorney for further guidance and direction, to possibly do a trust or consider some other nuances that you may not be aware of, such as if you're doing spousal refusal, the well spouse should be doing some asset protection and planning as soon as the ill spouse gets on Medicaid, so that if they come after them, they're a little bit better protected, and understand the risks that they're getting into, because nothing is a slam dunk. And even something as easy as making sure that you've provided your, that you have the right beneficiaries on everything when you go through the process, to make sure that Medicaid can't come after you when, after your assets when you pass away. So I think it is often a two-part process. Somebody who really doesn't have much money and who really doesn't have much income and doesn't really own any property probably doesn't need an elder law attorney and can go to a care manager or a Medicaid specialist for their planning. But very often people don't know what to even ask. They're not even sure of the information they're trying to get. And that's where I think somebody, with a little bit more background in social work or something, care management, can be more helpful, because they're really going to take the time to explain things that that they may need to know, so they can go into that evaluation with the lawyer a little bit better educated in the process. That's, again, I may be biased, but that's my opinion on that. I hope that helps. Okay, so if nobody else has any questions, we're going to end the webinar, and I am happy to, if anybody has any other questions that they feel they need to ask, you certainly can reach out to us. We're happy to try to give you that information. I do provide a similar webinar to this every week on Wednesdays, and I switch back and forth between community Medicaid and nursing home Medicaid, just so you know, because they are kind of different, and there's a lot of time involved. So I try to give people both things separately, and most people are looking at one or the other. So if that is something people are interested in, you can go to my website at medicaidsolutions.com and register there, and they are recurring webinars, but the information doesn't change a whole lot month to month or week to week, because it's basically the same. It's just giving people the opportunity to find the information. So thank you everybody for your support. And if you need anything else, give me a call. But I'm going to say, since I don't see any hands up and I don't see any more questions in the chat box, I am going to close out the webinar. So thanks so much, and everybody have a great day.